Okay, hi everyone, welcome to today's session. So for today's webinar, we are going to be talking about the second part of the ICT trading strategy. So if you guys weren't here for our first part of the ICT trading strategy webinar series, not to worry, because I will be doing a quick recap at the start. And also last week we had some technical issues, so I know there were a couple of questions from you guys in the chat. Um, yep, so I will be addressing a couple of those questions as well. If you have any other questions, feel free to pop them into the chat as well. Oops. Okay. Let's go ahead and get started. Okay, so as per usual, a disclaimer risk warning before we start. This information is not considered as investment advice or an investment recommendation, but instead a marketing communication. Risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll start off with a very quick recap for those of you guys who weren't here with us last week, where we did kind of an intro on what exactly ICT is and what are the key concepts. So I'll just be going through that. And then we'll jump right into how to apply the ICT strategy, the action plan, and also these concepts here. So liquidity pool manipulation, stop hunts, market structure, etc. And if we have time at the end, we'll go through a couple of slides, a couple of charts as well, if we have time at the end. Okay. So let's start off with what exactly ICT is. So ICT is now grown to become one of the most popular trading strategies around. It focuses solely on price action. So it was originally created by Michael Huddleston to trade the Forex market, but currently they can be used in any market. Focuses on understanding the inner workings of the financial markets, utilizing price action analysis to make informed trading decisions, and uses supply and demand zones. Okay, so why is it important for us to understand ICT or inner circle trading? So in today's pretty volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, such as support and resistance, price movements, order blocks, you can enhance your ability to identify higher probability setups, and trading opportunities and effectively manage risk. Okay, so let's jump into the key concepts. Again, this is a recap from last week. So if you guys weren't here last week, I'll just really quickly cover this. Okay, so firstly, these are pretty simple concepts to grasp. Some of them are just labeled in different terms. So I'll explain what I mean in a little bit. Okay, so the first concept is liquidity. So there are two types of liquidity, buy side and sell side. So here's an example of buy side liquidity. So buy side liquidity basically represents a level on a chart where short sellers have their stops positioned. So sell side is just the opposite of this. Okay, so it represents a level on the chart where long buyers traders will place their stops. So in both cases, these levels are found relatively near extremes. So you can see they're placed at swing highs or swing lows, um, and are often viewed as areas where traders are proven wrong, and therefore they'll want to get out of the trades. So it's basically where you can foresee um, prices reversing or bouncing off of. Okay, so smart money players typically will understand the nature of this concept and will commonly accumulate or distribute their positions near these levels where mini stops reside. So that's why we often identify these areas as large areas of resistance or support because oftentimes you'll see prices tend to react off of these levels. So once the level at which these stops are placed has been traded through, then it's often that price will reverse course, so either reverse or bounce off your support levels and will head in the opposite direction. So it'll often seek liquidity at the opposite extreme. Okay, so let's talk about the second concept, which is displacement. So it's basically a very powerful move in price action that results in strong selling or buying pressure. So generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. So you can see from the image that we've included, these candles typically have larger bodies and very short wicks. So it suggests that there's very little disagreement between buyers and sellers. So often a displacement will occur just after your liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. We'll talk about what those two mean in a little bit. Okay, so you can take note of the shape of these candlesticks. When we talk about shape of your candlesticks, we're also talking a lot about price action, and which is also a key concept when we later discuss how exactly to apply our ICT trading strategies. Okay, I think so far it's still quite straightforward. So let's move on. So the third concept is market structure shift. So this is pretty straightforward. Basically, you have two types of trends, an uptrend and a downtrend. So an uptrend is when price makes higher highs and higher lows, whereas a downtrend is just making lower highs and lower lows. So here's an example of a good market structure or something that you typically want to look out for when you are deciding on which charts to analyze. Okay, here's another example. Okay, and here's an example of a downtrend, and here we also have price moving in a descending trend line. So a trend line typically is the easiest way to show you whether price is moving in a downtrend or an uptrend. We typically only consider a trend line to be valid when there are at least three touches on the trend line, regardless if it's downtrend or an uptrend. Here you can see we have about four, where the fourth touch basically surpasses our descending trend line. So it just suggests that prices might continue moving upwards instead, since it's broken out of the descending trend line. Okay, so this is an example of a market structure shift from a downtrend into an uptrend. Okay, so now let's jump into inducement and fair value gaps. So this might be these are quite crucial concepts when it comes to ICT, but it might be a little bit harder to understand. So firstly, let's talk about inducement. So inducement is a liquidity concept where the market traps early traders before a real move happens. So here you can see it says really does the price move in a straight line. So within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So this is just another way of telling you that it often appears as yep. So what we mean by this, I guess to give you some examples, it can appear as retail traps where price moves in a way that tempts traders into premature entries. Number two is liquidity grabs, which is why we mentioned this is a liquidity concept. So the market can take out stop losses before it makes the real move. So that's what we mean by liquidity grab. And lastly, it can also come in the shape of a fake breakout or false breakout. So breakout that basically lures traders in only to reverse against them. Okay, so I'll give you an example before we move into the fair value gap. Okay, so here's an example of an inducement. Typically, they come after a market structure shift. You can see price was moving upwards, making higher highs, higher lows. Once the market structure shift occurred, um, then we started to see these inducement patterns happening. So an inducement is basically when there is a very short uptrend, not really uptrend, a short move upwards, and that is where you as a trader might get trapped in this area, and then it reverses back down. So that's what we mean by a false breakout. It's breaking out of this, I guess, pullback level, breaks out of it. So you think that, okay, price might continue moving upwards, and then it doesn't, and it continues downwards. And you can see price overall in this trend, it's moving in a downtrend, making lower lows and lower highs. Okay, so that's what we mean by it's a trap because it tends to liquidate manipulate the liquidity by inducing traders into a wrong direction before making a move. Okay, so let's go back and now we'll talk about fair value gaps. So fair value gaps can also you can think of it as an imbalance in price. So it's caused by institutional order flow and it appears as a three candle structure where is the middle candle's body creates an inefficient price gap. So that's why here you can see it says um if you look at it on a chart, it's a three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. Okay, so let's look at how to identify a fair value gap. So firstly is to find a large displacement candle with a strong momentum, preferably. Next is to ensure that the next candle doesn't fully retrace the previous move. And lastly, this leaves a price gap between the wick of candle 1 and candle 2. In this case, when I'm talking about identifying fair value gaps, I'm talking about the unfilled fair value gaps here. Okay, because we're not really concerned about the fair value gaps that have been filled. We're more talking about those that have not been filled. Because oftentimes we're expecting price to retrace to then fill up these FVGs. Okay. Any questions? I think this was the part that most people had questions on last week. So if you're still not clear or you weren't here with us last week, feel free to let me know what your questions are. So I guess your next question might be, how exactly are you going to use these FVGs? So firstly, you can use them as your support and resistance levels. Like I mentioned before, we're concerned with the unfilled FVGs because we're expecting price to retrace and fill up these FVGs. So you can see the fair value gaps that have been filled, price retraced and filled up these gaps. So looking into the future, we are expecting prices to then fill up these or retrace to these areas. So you can use them as support and resistance levels. You can also use them as entry zones for high probability trades, or you can use them as breakout confirmation. So if price respects the FVG without closing below it, then your trend remains intact. So meaning, here you can see prices moving in a downtrend. Prices are making lower lows and lower highs. So if price respects this FVG and it doesn't retrace, that is a sign that the downtrend is continuing. Okay, before I continue, just to double check, are there any questions? Okay, so oftentimes we will look for an inducement first. We're looking for these price that kind of sweeps with liquidity. So which basically means that there's equal highs and lows. Okay, and then we look for these FVGs. So these FVGs tell us that there is a strong displacement confirmation that is gaining institutional interest. Okay, then you wait for confirmation. So are these FVGs going to be filled up? And then that kind of tells you the direction. So if it's bullish or bearish intent, before you then enter in the direction of smart money flow. Okay. Okay. Any questions? Okay, if not, let's move on. So we're gonna talk about two more critical ICT concepts, which is your optimal trade entry, and this uses Fibonacci concepts, and also the balanced price range or imbalance. So let's start with optimal trade entries. So it represents the best place to get into a trade, and they can be identified by utilizing Fibonacci levels 61 and 61.8 and 78.6. So okay, let's quickly do a um Fibonacci retracement kind of intro. So if you are not familiar with Fibonacci, I'll just really quickly go through this. So like I talked about market structure at the start, we're looking for big zigzags. Next is to identify the recent trend. So our price is going down or up. Here in this example, prices are moving downwards. Identify the recent major swing lows and swing highs. So here you can see this is the highest swing high, lowest swing low, and then you connect these two extreme points. So another example here, for ICT in particular, your optimal trade entry is between the 61.8 to the 78.6 levels. So in between here. Here, another example here. So we would enter somewhere here. Okay. Now I'm gonna go back and talk a bit about the balanced price range. So balanced price range typically occurs when there are inefficiencies in the market, and then it later comes back to rebalance them. So this kind of ensures that price moves in a fair and efficient manner, which is why it's called balanced. So this concept explains why price often retraces back to key levels before it continues its trend. So how to use this? You basically want to look for a strong imbalance. So you can look for a displacement move with minimal pullbacks. Um, and you can also look at FVGs for this. Next, you can check your opposing price action. So if price later retraces and fills that imbalance, then it confirms a balanced price range. So if price respects this rebalancing area, then it's likely to continue in the intended direction. Again, how you use this, you can use it as support and resistance. You can use it as order flow confirmation. So if price rejects after rebalancing, then it's a good sign that the trend is continuing. Okay. Um, okay, any questions on this? So how you would kind of bring it all together would be to first look at the inducement, so where there could be potential liquidity grabs. Next step is to look at your FVGs, so where there is an imbalance or where a displacement candle leaves that imbalance or inefficiencies in the market. And then you look at your optimal trade entry using Fibonacci retracement followed by your balance price range. So price rebalances an old imbalance, yeah, which then signals market efficiency. Okay, so how you use that is you can place an entry um inside these two areas. So your optimal trade entry between the 61 and 78, you can place it there and alongside, perhaps an FVG zone as well. And then you place your stop loss below a liquidity sweep, so just below where you've identified your inducement. And then your take profit could be at the next liquidity pool or at a market structure level. Okay, which brings us to our next to today's topic, which is how exactly to apply the inner circle trading strategy. So we've already covered all of the key concepts. Last week we covered some trade management techniques as well. So for today we'll talk about how to exactly apply it. Okay, starting off, we have price action, liquidity engineering, imbalances, and smart money behavior. So for price action, I'll give a couple of examples on what exactly this means in a bit. Liquidity engineering basically speaks about the liquidity concepts that we've been talking about, inducements, um, buy side, sell side liquidity, and also liquidity pool manipulation, which is in the next few slides, I think. Imbalances, we've talked about this as well, and smart money behavior. Okay, so how exactly to apply the ICT strategy? Firstly, is to start with a higher time frame bias. So you can start looking at your daily or 4-hour time frames. Then you can mark out liquidity zones. So you're looking at equal highs or lows or trendline bounces. Next is to spot displacement and FVGs. And lastly, to drop down to a lower time frame, so you can use, we typically won't recommend anything below 5 minutes because it tends to get a bit noisier and harder to analyze on those time frames. But you can look at 15-minute, 30-minute time frames. Um, yeah, and also we'll talk a bit about order blocks. Okay, so let's first talk a bit about what exactly smart money um looks like or what exactly it is. Okay, so when it comes to smart money concepts, you're basically looking at order blocks, which is a basically supply and resistance. And we're looking at breaker blocks, mitigation blocks, flip zones, FVG, which we covered, and liquidity graphs, which we covered as well. So you can see there's a lot of overlap when it comes to when we're talking about smart money as well as ICT. Okay. Um, are there any questions before we move on? Sorry, am I speaking too fast? Okay, I will slow down. Okay, if there's anything you need me to repeat, just let me know as well. Okay, let's continue. Okay, let's talk a bit about liquidity pools. So, liquidity pools refer to areas on a price chart where significant clusters of buy or sell orders are located. This typically happens near your swing highs and your swing lows as well. So these liquidity pools act as magnets for price as they represent zones of substantial market interest. So by identifying liquidity pools and understanding their significance, you can anticipate potential price movements and position accordingly. So buy-side liquidity pools tend to occur above market price. Okay. Whereas sell side typically will occur below market price. So when we look at a chart, for example, the previous chart where we were looking at the swing highs and the swing lows, maybe I'll show you, right? So these, your buy side liquidity would occur above here. So your liquidity pool manipulation will happen above these areas here, um, and below. So basically the areas above your swing highs and below your swing lows. So often when these so how you would trade liquidity pools, I guess, is to firstly, if you're looking at bullish, just as an example, since we're looking at this chart, if we were looking for a buy side or a buy, for example, over here, you would spot firstly a sell side liquidity. So that's happening here at the swing lows. When you see that equal lows have formed at this key level, then you wait for the sweep. So sweep is basically when price breaks below, which you can see happen here. So your stop losses are then triggered. So your smart money entry, so going back to what we talked about, smart money concept, a smart money entry would be when you are using your fair value gaps or your order blocks as confirmation. So then um you would enter long or short depending on your trading strategy after price reclaims this liquidity zone here. Okay, so your target would then be the next equal highs or resistance level. Bearish example would just be the opposite. So you're looking at firstly a buy side liquidity when there are equal highs that are above your resistance level. Then you wait for your liquidity grab. So when price spikes above the highs and it triggers your stops, which you don't see in this chart here, but I'm just giving you as like a verbal example. So once it breaks above, it will trigger all the stops and you can confirm your smart money entry when there is a bearish order block and fair value gaps occurring in that area. Then you enter your sell entry After price rejects this zone, this liquidity zone here, and then you go in for your sell. So your take profit or your target sell side liquidity would then be an area similar to this area. So your sell side liquidity would then be your target. So you're basically just looking at these two liquidity pools. Okay. Okay, let me go back to our slide. Okay, so I realized I didn't cover what exactly an order block is. So the order block is simply a replacement for your supply or demand that your asset experiences. So it's just another term for supply and demand, which can also be your support and resistance levels. So that's quite straightforward. Breaker or mitigation blocks. This is your support and resistance levels. And your fair value gaps, this is what we talked about earlier, basically imbalances in the markets. Okay, so liquidity pool manipulation, I already talked about this. So now let's talk a bit about the price action side, which is a key concept in your ICT trading strategy or when you are applying it. So we'll talk about price action now. Any questions so far before we continue with price action? Um, okay, what is flip zones? Here, right? Um, so flip zones is basically a price level, or it can be a zone as well, where your support turns into resistance and your resistance turns into your support. So that's why we call it flip zones. So this normally happens after a significant market structure shift or displacement. Yep. So these flip zones typically will align with an order block or a fair value gap, and it's used to anticipate high probability entry levels. Okay. Um, okay, what specifically do you want me to explain more about smart money concept? Liquidity grabs. So liquidity grabs, I'm trying to think of a way to explain it. It's basically a deliberate move by smart money. So what we mean by smart money, I guess, is typically institutions. So can be your banks or basically big corporations. So they push price beyond a key level. So it can be like a swing high or a swing low to trigger stop losses or breakout orders so that it fills their large positions. Because obviously, as an institution, you have um, larger orders than your average commercial trader. So that's basically what a liquidity grab is. It's a deliberate move by smart money, which is your large institutions. So it can also be referred to as a stop hunt or a liquidity sweep when we look at ICT concepts. Okay, so I guess if I'm trying to explain how liquidity grabs happen, um, institutions can't enter these massive positions at random, right? So they need liquidity um to fill their orders. So these zones, so your stop losses beyond your swing lows or swing highs, these zones will become liquidity pools. So that's why we talk about liquidity pool manipulation. So smart money drives price into these areas to grab your stop orders, create liquidity, enter positions at better prices, and then they reverse the market. That's where you have your manipulation. I guess how to spot a liquidity grab is to look for, like I mentioned earlier, looking at um equal highs or lows. Okay. Yeah, we'll look at a live chart in a bit. Okay. Let me just cover the price action trading approach first. So when it comes to price action for smart money concepts, we're looking at the reversal and breakouts. Okay, so this is an example of a reversal over here. Um, we are also looking at specific candlestick formations. So here we have a morning star formation, which I'll talk about in a bit. And yep, this is your reversal as well. And a breakout basically is pretty straightforward. There's a resistance area that you need to break through, and then you have this formation here. Okay, and then we have another candlestick formation, the three white soldiers. Okay, and the breakout happens. So we're going to talk a bit more about single candlestick patterns since it plays quite closely to one of the key concepts for SMC and ICT. So we'll quickly cover the top three single candlestick patterns. Firstly is the hammer and the hanging man. So these are single candlestick patterns. So you're solely looking at this one candlestick in the middle where your candlestick is quite short and it's positioned either near the high or the low. Um, and your hanging man is obviously in a downtrend, hammer is when prices are moving upwards. Next, you have the inverted hammer and shooting star, which basically has no lower wick and a short body. Dragonfly doji and gravestone doji, these are just a T shape, shows you there's no body of the candlestick. Okay. So next, let's talk about the top two double candlestick patterns. We have bullish engulfing, bearish engulfing. So, okay, I have a question in the chat. Okay, so let's talk a bit more about the doji candlestick. So this basically represents indecision in the markets. So it forms, you can see it from the shape of the candlestick, it forms when the opening and the closing price is about the same or it's very close, meaning that neither bulls nor bears were in full control during that period when it's formed. Okay, so when you see this, it can suggest market indecision, like I mentioned, or it can suggest reversal signals. Although having said that, it can also tell you continuation. Um, yeah, you can't really look at the candlestick on its own. You have to look at it in context. So, yeah. So I can't really say whether it's a reversal pattern or a continuation pattern, can be either. Okay, let's move on to the next double candlestick pattern. Here we're talking about tweezer bottoms and tweezer tops. It's basically a repeated shape where there are no lower wicks and you have your body of the both candlesticks are about the same. Yep. So when I say you have to look at it in the in like contextually, you can't just look at it on its own because this doesn't really tell you much. So you have to see um what are how it's positioned in your price structure. Okay, because just looking at it on its own, it just tells you that the open and closing prices are basically the same. So it tells you that there's market indecision or temporary equilibrium between buyers and sellers, but that's all it says. That's all it tells you from here. Okay, so that's why, yeah, that's what I mean by you have to look at the context, or you can combine it with other technical analysis tools. Okay, and that applies for all the candlestick patterns that we're covering as well. So tweezer bottoms and tweezer tops, these are more reversal patterns as well. But of course, we will not tell you to solely rely on these candlestick patterns for reversal signs. These can indicate reversal, but you still want to make sure that you use other technical analysis tools. Okay, next is your triple candlestick patterns. So we did mention your morning star pattern and evening star pattern as well earlier on. Um, these are reversal patterns as well. So yeah, I don't have much to say about this. You just have one candle that follows the initial trend. The middle one is just a shorter body, and then followed by the new trend. So your star is the middle candle. So it's a small body candle and it's a gap down. It's typically looks like this. So there's a gap in between your first candle and the second candle. Okay, then it closes with the last candle. And that tells you that there's a potential reversal into a new trend. Okay, we have the black crows and white soldiers. These are more trend continuation patterns. You can see after the trend reversal, you can, yeah, this is just exact same candlestick repeated. So three black crows signifies selling pressure, three white soldiers signifies buying pressure. And it's mostly a steady progression, which suggests that there's a strong market sentiment in that direction, in that trend. Okay, and lastly, before I jump into the charts, we have the top three inside up and three inside down. These again are reversal patterns. Um, yeah, the first two candlesticks, the closing price is typically around the same. Um, yeah, it just tells you there's a reversal to the upside or reversal to the downside. Yeah. Okay, that's it for our price action. Yeah, so what I mentioned earlier, like I said, you want to combine your candlestick patterns with other indicators as well. So you can combine it with trend lines, channels, and other indicators. Okay, now let me pull up my charts and we can talk a bit about SMC and ICT. Okay, let me just pull up my charts. Okay, if there's any charts in particular that you want me to look at, you can let me know in the chat as well. Just give me a second, it's taking a while to load. Okay, let me share my screen. Okay. Okay, I'll answer your question in a bit. Um, let me just let's look at a chart first. Um, oh, okay, I have Hong Kong 50 here, which somebody requested for. So let's go ahead and look at this. So it's very similar when we talk about ICT to what we normally do. So we basically, like I mentioned earlier, look at the higher time frames first, right? Um, so ICT suggests us to look at either the daily or 4-hour time frame first, and that kind of gives you an idea of the general direction of price. So here we have prices moving downwards with a slight uptick recently. 4-hour time frame, it's a general downtrend as well. I think last week someone asked how to identify FVGs as well, and the easiest way is to just use a indicator. Okay, so it helps you identify all the fair value gaps in your chart. So like I mentioned earlier, these fair value gaps can also support and resistance levels. Um, so we can go ahead and do that. Okay, this will be my first support. Personally, I like to pull it all the way back so that I can see price has to the level.